All right, it looks like it's 10 o'clock, so we're going to go ahead and get started. Thank you for joining us for today's webinar on policies and procedures that every nonprofit should update. Today, we're going to talk about how to reframe policies as risk management tools, and then also why your auditors, funders, and boards should care about these policies. My name is Audrey Sadison. I'm a member of DWD's nonprofit team. Before we get started, I want to share a few housekeeping items. The webinar is going to be recorded and it will be available on our website after the conclusion of the webinar. Today's slides will be emailed to you as well, to each of you after the webinar. And then if you have any questions, go ahead and submit them through the Zoom Q&A screen. We're going to try to get to those as we go, but if we don't answer your question during the webinar, we'll follow up with an email to you. Also joining us today are fellow nonprofit team members Tyson Moore and Carrie Minnick. So with that, let's get started.
Thank you, Audrey, and thank you all for attending today's session. We're going to start off with a couple questions for you. How many of these, when you think as to your current status within your organization, are true for your nonprofit? Your conflict of interest policy hasn't been updated in years. Your online banking policy doesn't mention ACH or MFA, multi-factor authentication. You have a disaster recovery plan somewhere, but you just aren't sure where it's at. Your board approves policies that they never actually read, or maybe your staff just aren't sure where the policies are located. If you answered yes to even one of these, you're not alone. Most nonprofits have policies in place. Far fewer have policies that actually reflect how the organization operates today. So that's what we're going to focus on. Policies are not just paperwork. It's not just something that we need to write up and put on a shelf somewhere. These are your organization's operating policies, how you do your day-to-day operations, how you achieve your mission. Without them, there's just going to be too much indecisiveness, guessing, fraud may become easier, compliance might have issues. There's just going to be too much uncertainty, and things are not just going to go as smoothly if we don't have these policies in place. So when we talk about policies, we have different types of policies to cover different types of risk. So the first policies listed on the screen kind of address financial risk. So how could someone accidentally or intentionally lose money or steal money from the organization? So these policies here on the screen are policies that should be in place to kind of cover that risk, to lessen that financial risk. Then we have governance risk. So how do we make sure that our leadership, both the board, executive director, leadership team, make ethical decisions? So these are the policies that you'll want to have in place to cover this risk. Next is operational risk. And these are like your day-to-day operations. So, your executive director is the person that's in charge of the day-to-day operation. So what if that person suddenly quits? Or what if that person suddenly comes incapacitated somehow and can't come to work tomorrow? These policies, by having these policies in place, your organization should be able to continue if that person were to leave suddenly. And then we have reputation risk, which is probably the most important risk within a nonprofit, because your reputation is so valuable. We want to make sure that nothing happens to that. The trust that our donors put into us, the community puts into us. And these policies on the screen are the ones that address that risk. So why do we care about these policies? Specifically, why do your auditors, your funders, and your boards care, or why should they care? So I know not all nonprofits have an audit, but a lot of them do, whether it's because the bylaws require them to have an audit, or a funder requires them to have an audit, or maybe they get government money. Auditors are not looking for policies just to check a box. We're not going to say, do you have these policies in place? Yep. Okay, good. We're done. We're going to check that box. Yes, that you do. We use these policies to understand whether your organization has designed appropriate internal controls and whether these controls are operating as intended. So when you have an audit done, we don't necessarily test internal controls, but we have to gain an understanding of your internal controls in place, because those directly relate to your financial reporting. So we look at questions such as, does management have written expectations for handling financial transactions? Are employees following consistent procedures? Are responsibilities properly segregated? I know segregation of duties is a huge issue when we do nonprofits. Are we properly segregating who's receiving the assets, who has custody of the assets, who can approve the assets, that type of thing? Does the board provide appropriate oversight? And are policies current and appropriate for the organization size and complexity? So what's going to concern us is policies that have not been updated in years. So maybe the last time a policy was updated 10 years ago. If we're talking to employees and they cannot explain the policy, or maybe they're not following the policy, that means the policy hasn't been communicated properly. Or similar to that, policies that conflict with the actual practices that are taking place, missing approval documentation, weak financial controls, or just lack of documentation. So if your organization has a written policy in place that is ignored, it's actually more of an audit concern than having no written policy in place, because it demonstrates that the internal controls are not operating effectively. So I'm not suggesting that you just shouldn't have policies in place. We want to have policies in place. We just want to make sure that we're following those policies. So why do your funders care? Funders are investing in your organization's ability to accomplish its mission responsibly. They want confidence that their grant dollars that they're giving you will be managed appropriately. Increasingly, grant applications ask applicants to submit policies before funding decisions are made. And so they're becoming more and more involved with what kind of policies the organizations have in place. They want assurance because they want to make sure that the money that they're giving to the organization is managed effectively, efficiently, how it's supposed to be, that it's safeguarded. Purchasing decisions are fair, that the information is protected. Financial reports are reliable. Oftentimes, donors will request a end of grant reporting, and so they want to make sure that that report that they're getting is legit, that it's reasonable. And so in order to make sure that that is true, we want to make sure there's proper controls and procedures in place. A nonprofit with strong governance policies often appears to be a lower risk grant recipient. So why should your boards care? The board has a fiduciary responsibility to oversee the organization. Policies allow the board to establish expectations without managing day-to-day operations. As I mentioned before, the executive director is responsible for day-to-day operations, while the board is responsible for the overall organization. Policies become one of the primary ways that the board fulfills its duty of care. So good policies can help the board delegate authority appropriately. They know that there are policies and procedures in place for the staff and the executive director to follow through on those day-to-day operations, define management responsibilities, protect the organizational assets, promote ethical behavior, and so forth. So we have the three perspectives. Auditors. They're focusing on our controls designed and operating effectively, and that's part of our audit procedures. Funders are asking, can we trust this organization with our resources? Again, they're providing you with funds to carry out some type of program or mission or something. And so they want to make sure that who they're giving that money to is using it appropriately. And then boards are asking, are we protecting the mission? So let's talk about specific policies. Now, the policies that we're going to talk about today obviously do not encompass all policies that an organization might have in place. We're going to talk about some of the more common ones, or ones that organizations really should make sure that they have in place. Depending on what type of organization you are, you might have to have other policies that we don't talk about. For example, if you're like CARF certified, you might have to have certain policies, or just health related or something like that. So just keep in mind that if I don't talk about a policy, doesn't mean that it's not important. We're just going to we've just picked out some ones that are more common and that we think all organizations should have in place. So first, let's talk about some governance policies. So again, the first one we're going to talk about is the Code of Ethics and Code of Conduct. So this policy establishes expectations for ethical behavior by employees, board members, and volunteers. So we want to make sure that we have a good tone at the top. because a good tone at the top is going to flow through the rest of the organization, and it's going to reduce misconduct, promote accountability, and protect the organization's reputation. Because again, reputation is your most valuable asset. So I've listed on the screen here some of the different items that should be included in the Code of Ethics and Code of Conduct. If you have a code of conduct or a code of ethics in place, there may be some red flags that are occurring that you might see that would indicate that maybe this policy is not acting as it should be. If employees are unaware of the policy, make sure, again, with all policies, as soon as you implement a policy or update a policy, that those policy changes get communicated out to everyone that it impacts. There's no acknowledgement process, or ethics violations are handled inconsistently. So again, this policy is going to address that. So, and as we go through these policies, if there are policies that maybe you don't have and would want a copy of, you can just let us know, because we do have some templates of a lot of these different policies, and we are happy to send these out. Next is the conflict of interest policy. So the IRS actually requires all nonprofits to have a conflict of interest policy when they apply for nonprofit status. So if your nonprofit if your organization became a nonprofit many, many years ago, that might not have been a requirement at the time. But currently, and for the last few years, the IRS is really big on making sure that those entities that are applying for tax exempt status also have a conflict of interest policy, and also making sure that it is implemented, followed, and signed. So a conflict of interest policy requires key employees, the officers, board members, to disclose any possible conflicts that may occur within the organization. So for example, if a board member their spouse maybe has a marketing business and the organization uses that business for their marketing purposes, that's totally fine. That's allowable, but we just need to make sure that everyone is aware of that relationship, and then that would be disclosed as a potential conflict of interest with that board member because of their relationship with that marketing company. Again, transparency helps ensure decisions are made in the best interest of the organization and protects that public trust. So for that example that I just gave, we want to make sure that that board member or that marketing company is not receiving any kind of special benefit because of the relationship with the nonprofit. Again, I've listed some items that should be included in the conflict of interest policy. And again, some red flags if your annual disclosures are not completed. So again, we want to make sure that we not only have a policy in place, but that they are getting signed every year by the board members and key persons of management. If there are any types of related party transactions, we also want to make sure that they are documented. Usually that's done in the board minutes. And then if there is a vote to approve, maybe to use that marketing company for the nonprofit, that is documented in the minutes, and then that board member would abstain from voting on that specific vote. Next is the Form 990 review policy. So the IRS Form 990, which is your annual informational return that's filed with the IRS, specifically asks if the form is reviewed by the full board prior to it being filed. So since this question is asked, there should probably be some kind of policy or procedure in place as to how that gets done. So having a review policy in place kind of just defines how the management and board responsibility for reviewing Form 990 before filing. So it can be very as simple as, we have our auditor prepares the 990, they provide a draft of the 990 to the finance committee to review, and then it goes before the full board to review prior to filing. Again, the Form 990 is a public document. Unlike for-profit tax returns, anyone can go out on the internet and pull up your organization's Form 990. So you want to make sure that everything reported on that Form 990 is appropriate and correct. So that's why it's so important that your board review Form 990 to make sure that is true. I've also included some items here that should be included in the policy, and then also some common red flags that may be in existence if your policy is not being followed. Next is the officer's compensation policy. So this is a really big one because the IRS, this is one of their focus areas with nonprofits, is officers' compensation. They want to make sure that officers, which include like the CEO and executive director, are not paid an excessive compensation amount. Now, normally, especially around the Fort Wayne area, this probably isn't a big deal, but still, we want to make sure we're documenting how we're determining our officers' compensation. And this also is a question that is asked on Form 990 as to how the officer's compensation is determined and if it's documented. So the three key requirements when determining officer's compensation is it must be reasonable. And in order to determine if it's reasonable, what you need to do is look at comparable nonprofit organizations to see how much they're paying their officers. So for example, organizations within like Allen County, Indiana would probably compare with other organizations in Allen County, Indiana, or in the Midwest. We wouldn't want to compare with an organization in California or New York because that really wouldn't be comparable. The compensation also needs to be documented, which means it actually needs to be written down and it needs to be approved by the board of directors. And this should be done every year, not just once. So again, this policy establishes procedures for determining executive compensation, which demonstrates fairness and also reduces compliance and regulatory risk. So this is something that if you are not currently doing, this is one that I highly recommend that you put in place at the top of your list to do that. Because again, if there's any question on how much you're paying or what you're paying your executive director or CEO. That way you can have the documentation to prove why you have paid that individual that amount and that it's been approved. Next is political activity policy. So this policy defines permissible political and lobbying activities consistent with the organization's tax exempt status. So nonprofits are limited as to how much activity they can be involved with, whether it be political and lobbying activity. 501c3 organizations are specifically prohibited for any type of political activity, so we can't get involved at all. Now, there are certain types of lobbying activities that organizations can be involved in as long as it's not a significant amount of their activity. So that is why this policy is so important, because we don't want to jeopardize our tax exempt status. So putting something like this in place will make sure that not only the organization's top level leadership, but also staff are they're familiar and they understand what they can and cannot do in the political realm as an employee of the organization. Next is a whistleblower policy. So this is actually a policy that, again, the Form 990 asks if you have a policy in place. And when the Form 990 is asking if you have these policies in place, they're asking it as of the end of the fiscal year when your 990 is filed. So let's say you have a December 31st, 2025 year end. So when you file your 2025 990, it's asking you if you have that policy in place as of 12/31/2025. It's also asking if it is written. So if it is not in place as of 12/31/2025, you have to answer that question no. And if it's not written, you have to answer that question no. In addition to being asked in Form 990, the whistleblower policy is also one of the policies that came out of the Sarbanes-Oxley Act that is required for all organizations. So the Sarbanes-Oxley Act, as a result of Enron and all of the fraud that happened at that point in time, and there were certain policies that the act required of for-profit entities, and there were a couple that were required of nonprofit as well, and this was one of those. So a whistleblower policy provides a confidential process for reporting suspected fraud, unethical conduct, or violations of law or policy without fear of retaliation. So basically, if an employee or volunteer within the organization thinks that there's something going on that might not be right, this provides a conduit for them to report that activity without being feared of being fired or demoted or anything like that. So it's very important that you have one of these in place, and again, and make sure that it's communicated to everyone what that process is. So if the staff, if you have one of these in place, but the staff don't know how to report the concerns or they're not being documented or handled appropriately, you might want to revisit that policy to improve that. All right, so those are kind of some of the key governance policies. Now let's move on to financial policies. So the biggest one is an accounting policy, which is kind of what you think it would be is, establishes your accounting principles and procedures to record financial transactions. So who is doing the bank reconciliations? How are those being done? How are checks being written? Who is doing that? Who is making deposits? And when you do this, when you write up this policy, when you're noting the person responsible for each step, you want to put the position name, not the individual, because obviously that individual is not going to be there forever. So you want to put the position title, not the individual. Having consistent accounting policies is going to help you reduce errors in your financial statements. It's also going to help if someone suddenly leaves, so we know who is doing what. It also helps with making sure there's proper segregation of duties in place, making sure that someone who is in charge of custody, there's someone else in oversight and someone else handling all the different types of assets. This is probably one that maybe doesn't a lot of people have in place, but they don't update it as much as they should. Sometimes policies and procedures change with maybe you have new staff added or you kind of change responsibilities and this policy doesn't get updated. So kind of taking an inventory and auditing of what your current accounting policy is, and is that actually how you're doing things? The next financial policy is a budgeting policy. So hopefully all of you have a budget in place. If you don't, I would highly recommend that you start budgeting. The budgeting policy defines how the annual budget is developed, approved, monitored, and amended throughout the year. So a budget is a plan. It's a roadmap for your organization for the next year. We want to make sure that we're not just throwing a budget together because a funder has asked us to, that we're actually using this as a tool. We don't want to just create a budget and say, yep, we created a budget and put it on the shelf. We want to make sure that we're using it as a tool throughout the year to see if we are meeting our goals. And in order to do that, we need to make sure that it is properly prepared. Again, there are some items on the screen that should be included in the budget. One of the common things that I see with budgets is that sometimes they aren't approved until after the fiscal year starts. That's not really a good practice. In order to truly use the budget as it's supposed to be used, we really want to make sure that that budget is put into place and approved prior to the fiscal year starting. So that way, when that first day of the first day of the new fiscal year starts, we have something that we can compare it to. So here's our budget for the year, and we can compare to where we're at actually to see where we're at. If you have significant variances, when you're comparing budget to actual, you might want to reevaluate your budgeting process. Now, granted, there are some times when, maybe a grant that you were expecting doesn't come in and that's going to create significant variance, or, maybe you have a key employee leave and that's going to be significant variance in salaries. But for the most part, it should be, if you've done the budgeting process correctly, it should be pretty consistent or at least explainable. So if your budget to actual comparisons are way out of whack at month after month, your budgeting process probably isn't the best, and you might want to reevaluate how that's being done. Next is a credit card policy. So first thing I want to mention when we talk about credit cards is, there's credit cards and there's debit cards. We highly recommend that an organization use a credit card versus a debit card. Debit cards are directly linked to an organization's bank account. So basically, whoever has that access to that debit card has access to the bank account. They can also take money out of an ATM. There's less restrictions on a debit card than a credit card. It's also, if you have a fraudulent charge, it's much easier to address that through a credit card than a debit card. So first thing is, if you're using a debit card, I would highly recommend you start not using that anymore and switch to a credit card. So we know, sometimes you have to use a credit card as opposed to writing a check, which is perfectly fine, but we want to make sure there's written controls over the credit card use. For example, who can use the credit card? What can they use the credit card for? Some organizations might not allow the credit card to be used for the purchase of alcohol just because that doesn't fit within their mission. And that's perfectly fine. That just needs to be documented in their written credit card policy. Also, again, going back to who has access to it and who can use it, that is going to drastically limit your risk of fraud as to determining who has the credit cards. Obviously, most of the time, not everyone needs to have a credit card. So we need to know who needs a credit card, who can use it, and who and what they can use it for. But also at the same time, what are the procedures for them to submit those invoices, those receipts for those credit card purchases? Because just because it was purchased on a credit card doesn't mean that that credit card statement is the support that we need. We also need to have that receipt from the vendor that actually shows what was purchased. So the written policy needs to include how that process is going to work, who that needs to be given to, those receipts, when it needs to be given to them, and the reconciliation process. Next is an endowment policy. Now, not all organizations may need to have an endowment policy if you don't have an endowment. If your organization is struggling to support your daily operations, struggling to pay payroll, and you have to draw on your line of credit, you probably don't want to start an endowment. So this policy would not be relevant to you. However, organizations that do have endowments, this policy establishes how the endowment assets are invested, spent, and monitored. So obviously an endowment is when a donor gives money to the organization, and then that principal amount just sits there and it grows, and then the organization uses the interest, the earnings off of it to support operations or programs or whatever the endowment says. So this policy is important to make sure that the donor's wishes are being followed, and that we're also investing prudently and taking that money out as we should. Sometimes there may be a year where the market's maybe not as good and maybe it drops. So this policy would kind of address that. So in those off years like that, are we going to continue to take out whatever our spending policy is? So let's say we have a 5% rate, which every year we draw down the endowment 5%. Well, this year was a really bad market year, and we didn't even get 5% earnings. So are we going to continue to draw down 5%? Or are we going to maybe not take anything out? Or maybe we'll just take 2% out? So that policy kind of addresses those types of things. Next is the expense allocation policy. So all nonprofit organizations are required to allocate expenses both on Form 990 for the IRS, and then also if you had an audit or review done by function. The three functions are program, management in general, and fundraising. There are certain expenses that are directly relate to program, directly relate to management in general, directly relate to fundraising. Those are super easy. So like, for example, your audit expense, that is the management in general expense. We put it in the management in general column. However, there are some expenses, most notably salaries, that are going to be allocated between the three different functions, normally based on how much time an individual spends on those different functions. So this policy is going to document your allocation methodology. So for example, for salaries, we are going to allocate salaries expenses and those expenses related to salaries, such as payroll taxes, retirement expense, and so forth, based on the time that the employees spend in each of one of those functions. Another type of expense might be like utilities or telephone. We're going to allocate those based on square footage. So that's what this policy says, because the requirement is that the policy needs to be reasonable. So that expenses need to be allocated on a reasonable basis, but then they also need to be consistent. And so this policy just makes sure that that your organization is allocating those in a reasonable, consistent manner year over year. Next is your investment policy. So again, this may be a policy that not all organizations have in place if you don't actually have investments. So if you don't have investments, it's fine not to have this policy in place. However, if you do have any type of investments, you should probably have a written policy in place that talks about how you're investing those funds, both in a prudent and consistent manner, but then also what is the purpose of those investments? And you want to balance risk. So for example, some organizations might not want to invest in private equity, or they might not want to invest in Bitcoin. So this policy would state that. Or some organizations might want to allocate, 50% into bonds, 30% into mutual funds, and so forth. So this policy would note the allocation of how we're allocating our investment. Again, it's showing that we're being prudent and responsible with the organization's funds, and that we have this written documentation so that everyone is aware of, so we know how to follow those investment policies. Next is a month-end accounting policy. So we previously talked about your accounting policy as to, in general, throughout the month, how things are being done, who pays the bills, who makes deposits, and so forth. Well, this month-end accounting policy is kind of a follow-up to that. So at the end of the month, this policy defines the procedures for completing the monthly financial close. So this really shows we want to make sure that everything that is reported on our monthly financial statements that's given to the board or finance committee to review has been properly reported, and that we've also included all transactions for the month. So this policy is going to make sure that we do that. And this is really, it could be like a checklist of like, okay, have we gotten our bank reconciliations done? Have we made the journal entry to review receivables to make sure if there's anything that should be written off? Just kind of a checklist at the end of the month to make sure, yes, everything that happened this month has been reported properly. So it can be reported in those financial statements that then management and the board use to make decisions. Next is the online banking policy. So more and more organizations, obviously, and individuals are going to online banking. So this policy establishes controls over electronic banking activities, especially with the onset of more and more fraud with technology. This is a very important policy. Electronic transactions can create significant fraud risks if there's no controls behind them. So again, using as far as like ACHs, who is able to access the bank and pull funds out, and what can they do with those funds? Is there multi-factor authentication required? Things like that. Maybe you use positive pay, and just at a basic level, who has access to it? Who can, a lot of times there will be different levels of access. So some individuals within the organization may be able to log in and just view. So you could only see the transactions or see the balance in the bank account. Other people within the organization may be able to make actual transfers between accounts. So this policy states that. One thing that we see sometimes is not only with the online banking policy, but just like authorized signers in general, when a key employee leaves that had access to your bank account, whether it be online access or was like a key signature, their name does not get taken off, and they are still listed as an authorized signer or authorized person to access your bank account. You want to make sure that when someone leaves, whether it be on their own or if they're terminated, that there's a policy or procedure in place to make sure that that individual's name gets removed from your organization's account. I know we've seen that sometimes in our audits where someone left during the year, but their name is still on the bank account, and we really don't want that to happen. So make sure you put that in your checklist for when individuals leave. Next is petty cash policy. So, your petty cash is that small amount of cash, maybe $200 that you have on hand for just small things that come up where you just need to pay something quickly. So this establishes procedures for managing those small disbursements. Even though the amount might be small, it can add up, and it can be a prime spot for fraud to occur. I've seen instances in the past where someone submitted a mileage reimbursement, but it was only like $20, but they did it every week and it got paid out of petty cash. And it was fraudulent. It wasn't legit mileage, but they submitted it every week. And so by submitting it every week, it just added up and added up. So making sure that you have some kind of policy in place as to, again, who has access to that, what it can be used for, the receipts that need to be submitted afterwards, after the cash is spent. Just making sure that that cash is accounted for because it is an asset of the organization. Next is a reserve policy. So a reserve gets set up by an organization sometimes when the board decides, okay, we're going to set a certain amount aside for like a reserve for like a rainy day, or maybe for like, we're going to start a capital campaign. So we're going to set up and put certain amounts in a reserve, or we just want to make sure that we have 3 to 6 months of cash on hand. So we're going to put it in this reserve. So this policy defines the organization's target operating reserve and the circumstances under which reserve funds may be used. So for example, again, let's say our board decides we're going to put 6 months of cash, or 6 months, we're going to set it aside in either a cash or an investment account, enough to cover 6 months of expenses. So then this policy is going to say what is being used for, when it can be used. So when can we pull the money out of there? But then also, do we need to put money back into it? So it just provides some additional financial stability during unexpected cash flow times and economic downturns. Not all organizations have a reserve. That's fine. That's your prerogatory, or your priority. That's fine. It is a higher priority for some organizations to have something like this. If you don't have a reserve, then obviously you don't have to have a policy in place. But if you do have one, you should have a written policy in place that goes along with it. All right, moving on to donor and fundraising policies. So donor privacy policy. So nonprofit organizations get a lot of information that is probably considered, personal, private information that should not be made public. So this protects donor information and establishes expectations for the collection, storage, and sharing of donor data. Because again, maintaining your donor confidentiality strengthens trust and reduces privacy risks. Obviously, if someone gave us money and they found out we were plastering their name or their information all over the internet, they probably aren't going to give us money anymore. And obviously, that's not something that we should do. But so we want to really respect our donors and other, people that give to us, whether it be grantors or individuals, businesses, whoever it is. We want to make sure that we, maintain that private information. Especially with like credit card numbers, if they're paying by credit card, any kind of private personal information. So this policy again just addresses that. Next is a fundraising policy. So this establishes ethical standards and procedures for fundraising activities. So why does this matter? Well, consistent fundraising practices, again, protect donor confidence and support compliance with applicable regulations. So for example, there might be some types of fundraising that an organization just doesn't want to get involved in, whether they don't agree with how it's being done, or maybe they don't feel that that is a good use of the organization's funds. That would be included in here. But also, it should also include policies or procedures on making sure that you're giving those thank you letters that support contribution substantiation to your donors. And also making sure that you're following the donor's wishes related to any kind of restricted donations that they're giving to the organization. Similar to that, gift acceptance policy defines which types of gifts the organization will accept and under what conditions. So not every gift is a gift. For example, if your organization has never owned a building before, and all of a sudden someone says, hey, we want to donate this building to you, and this building is old, and this building needs a lot of repairs in order for it to be used. Is that something your organization is willing to take on? Because not only now do you have a new asset, you've never owned a building before, you have to put in additional costs to repair it. You're going to have additional costs related to insurance. You're going to have additional costs where you need people to run the building. So sometimes when someone says they want to give something to you, it might not be something that an organization wants to accept. Another good example is Bitcoin. Is your organization set up to accept Bitcoin, and do you want to? So a gift acceptance policy would include what type of gifts that your organization is willing to accept. And it just makes it easier not only for staff. So if someone wants to donate something and the staff can just say, look, you know what, our gift acceptance policy is this, we can't accept it. So it just makes it clearer for them to deny gifts if that was a gift that the organization would not accept. All right, so moving on to operational policies. Disaster recovery plan. So when we think about disaster recovery, we probably think about like tornadoes or hurricanes or that kind of things. Yes, that does get covered in this policy, but you know what else gets covered in this policy? COVID. That's a really good example because when COVID happened, how many people had a policy or procedure in place to make sure that their organization continued to work effectively, provide programming when this pandemic was going on? So this provides a plan for restoring operations after a natural disaster, a cyber incident, or any other emergencies. Business continuity minimizes service interruptions and protects financial records and critical systems. If anything should happen, whatever kind of disaster it is, we want to make sure that our organization can continue to operate, can continue to provide our programs to the community, can continue to pay our bills, can continue to accept donations, and so forth. So this policy does that for us. Next is document retention and destruction policy. So this is another policy that Form 990 asks whether your organization has it in place. And also it's another form that is required by Sarbanes-Oxley for all entities. This defines how long organizational records are retained and how they are securely destroyed. Normally, the policy will list different types of documents. So for example, bank statements, board minutes, your IRS determination letter, and so forth. Some documents, like your IRS determination letter, you're going to maintain in perpetuity. So you want to always keep that. Other documents, maybe you only keep 7 years. So this document retention destruction policy says how long you're going to keep various types of documents. It's also going to tell you how you're keeping those. You do not have to keep them on paper. You can maintain them electronically, sorry. That's perfectly fine. But then you're also going to say how they're going to be destroyed after that 7-year period or 5-year period or whatever that period is. Now, there also needs to be a sentence in there or noted that should any type of lawsuit become expected or you think it's going to happen or it's currently happened, you have to cease all destruction of documents. So again, that's going back to the whole Enron thing. So how we're keeping our documents, because again, we want to make sure that we're maintaining documents to support our activities to prove that we are a nonprofit entity. That's what this policy is saying. But we also want to make sure that should any kind of legal issues come into play, that we cease destroying those documents. Next is an emergency succession plan. Now, when do you think that you should start putting an emergency succession plan in for your executive director? The answer is day one, when you first hire them. Your executive director, CEO, might leave after 30 years with the organization. However, they might leave after 10 years. Or something might happen and they might become ill, or a family member might suddenly pass away, which is going to take them away from their position. So an emergency succession plan provides temporary leadership plans if key executives become unexpectedly available. And normally within this policy, there's different timelines of when the person is gone. For example, it could be a short time that they're away and that they're going to come back. Or it could be a certain number of months where it's a longer time and they're going to come back. Or it could be a time where they suddenly left. So what are we going to do? Again, it goes back to making sure that our organization can continue to operate, provide programming, complete our mission, should there be a sudden lack of leadership. So we want to make sure we know who is taking over to continue the organization moving forward. So again, this is a very important one. This one kind of specifically addresses executive director, that CEO position, but it would be a good idea also to think about your board. So what if your board chair suddenly left? Who would step into that spot and move forward? Because, you know, your board is also leading the organization. So that's another very key role that some organizations don't think about. Next is your employee handbook. Obviously, this communicates your employment policies, workplace expectations, benefits, organizational procedures to employees. I think everyone is familiar with employee handbook. There's also, certain things legally that should be included and not included, so I'm not going to go into that. I think the biggest thing about employee handbooks is that we see is where they haven't been updated or they're not being followed appropriately. For example, vacation. If your employee handbook says one thing, but that is not how vacation is actually handled. I know that seems like such a small thing, but it impacts your employees, it impacts your financial reporting. So just make sure that your employee handbook is, well, first of all, that you have one and that all employees are aware of it, but that's being followed, that this is how you're actually doing your operations within your organization. Next is expense reimbursement policy. So this defines how employees and volunteers are reimbursed for authorized business expenses. So sometimes you might have an employee that needs to purchase something with their own credit card, but it is a legitimate business expense. So you want to reimburse them for that. So we just want to make sure that there are clear reimbursement procedures in place to ensure, consistency on how that's being reimbursed, that it's for a legitimate business purpose and so forth. Next is information technology policy. This establishes standards for the secure and appropriate use of technology resources. I think this one also is very important with all of the work from home that's going on, which is fine. So, who can access the organization's different programs and how can they do that? Do they have to be, within the organization's office in order to access the accounting software, or can they remote in? What kind of social media can they be on during the day on a work computer? Again, with all of the cybersecurity hacks and everything that's going on, just making sure that you are protecting yourself in the information technology world. Next is the procurement policy. This is especially important if you receive government funds. It establishes fair, transparent, and competitive purchasing procedures. So for example, when you have to go and select a vendor to maybe do a construction project, this policy would come into play and it would determine how you select that vendor. So do you need to get like 3 bids, 4 bids? How does that work? How do you go through and approve the vendor? That type of thing. Not only does it ensure responsible spending, but it also, again, is kind of a requirement when you do get government funding. So making sure that you have that in place as to how you select your vendors. Next is a risk assessment policy. This establishes a structured process for identifying, evaluating, and responding to organizational risk. So risk is basically anything that could impede you from carrying out your mission. So this regular risk assessments help organizations anticipate challenges rather than simply reacting to them. So this is maybe not necessarily a full-on policy, but a discussion as to, okay, the board is going to talk about, or, management's going to talk about what kind of risks, what could happen to our organization to prevent us from providing our programs. Are we okay in accepting that risk, or is there something that some control that we need to put in place to lessen that risk? And so that's what this policy does. Next is the volunteer policy. So if you have volunteers, which many organizations do, volunteers are great. A lot of nonprofits rely on them. It defines expectations for recruiting, training, supervising, and recognizing volunteers. So again, your volunteers, they're different from employees. But they still represent the organization and should understand their responsibilities, expectations, and safety requirements. So making sure that there's some kind of policy in place, not only a volunteer policy, but also maybe some onboarding or training that you provide to your volunteers. So that way they understand, again, their responsibility and the organization. So that was a lot of different policies. And again, that's not all the policies that you can have, but those are kind of more of the either required ones or more common ones. And I want to leave you with some tips. So your policies, like I said before, it's not just let's create a document and put it on a shelf. These are living documents. They need to be actively used and reviewed. At a minimum, organizations should establish a regular review cycle and document when policies are updated and approved. So if you have certain things that change within your organization, that's probably going to trigger a review or a change to your policies. So for example, leadership changes, or if you add a new program, or you move to a different location, or if there's changes in accounting or technology. When those different changes happen, we want to think, okay, should we change any of our policies because of these changes? And how we do that, we need to create a review process. So best thing is to, okay, we have all these policies. Let's create a library of all our policies. These are all of our written policies that we have. Now, who is responsible for these? And then also documenting, okay, when is the last time this policy was approved? We put together a little policy review process. So when you're going through and looking at your different policies, when you have your list of library for all of your different policies, you can put them into 3 buckets. The first is the green bucket. So we're good to go. This is a current policy. It's just been reviewed not very long ago. Everybody's aware of it. They know how to follow it. It's being followed. So we're good. So we're going to put that in the first bucket. We're good with that. We really don't need to do much with that. The next type, yellow, that's kind of a warning. So maybe we have a policy that we have a policy in place, but we need to have some minor changes that need to be done to it. Or we know that there's a revision that needs to be done to it. Or maybe that just needs to be approved again. So that's going to go in the second bucket. And then the final bucket, the red bucket, we got to redo these policies. So either we don't even have this policy in place, or it's super old and hasn't been reviewed or approved in years, or no one follows it. So when you're going through your policies, I think that's where I would start is, okay, let's look to see what policies we have in place and kind of put them in these 3 buckets, because that can kind of help you move forward as to what the next step is. So let's say an organization has these policies in place, but again, if you have a policy in place and it's not followed, you might as well just not even have the policy in place. So for example, let's say we had a nonprofit. They had all these great policies in place. They had a credit card policy, and all these were written and approved. They had an online banking policy, segregation of duties. They had an employee handbook, accounting procedures. They even had an annual audit. Everything looked great on paper. Then we hired a new accountant. The old accountant retired, so we had a new employee come in, and the new person started, but nobody really sat down with them and said, here's all of our written policies. And also, just for convenience, this new accountant, we gave them bank administrator access, ACH approval authority, credit card administration, and vendor setup authority, because it was just easier for them to just do that. Then we don't have to wait for different people to be involved. Let's just have them do it. So this was going on for about 2 years. No one thought about the policies. No one thought about saying, hey, that's not how we do our policies. They just continue to go forward. Well, eventually, it was found out a fake vendor was created. Payments weren't approved. Money was stolen. So the board found out about this, and the board asked, hey, don't we have policies for this? Yes, we do. We have all these great written policies, but nobody's following them. So we want to make sure that just because we have policies in place, people know what they are and are being followed. They're one of the strongest internal controls that a nonprofit has. We want to make sure that they actually reflect how the organization operates. If you have a policy in place and you're not following it, again, that is a bigger red flag than not having a policy in place. So again, go back, audit your policies. Are these written policies here what we're actually doing? Regular review helps organizations adapt to changing risks, technology, and regulations. Have a review scheduled. Over so many years, we review these policies. Then on these other years, we review these policies. Well-written policies promote consistency, accountability, and good governance. And again, a policy is valuable only when it is understood, implemented, and reviewed regularly. So thank you for attending today. Hopefully you were able to learn something about policies. Again, if there's anything that our team can help you with, please don't hesitate to reach out. All of our contact information is on the first, one of the first slides. Also wanted to share just on our website, we have some nonprofit specific resources. We have a blog. We also have our upcoming webinars that you can sign up for. You can also view our prior webinars that we've had. So we do make all of this totally for free for nonprofits. And again, just want to thank you for attending today and all that you do in our nonprofit community. Thank you.